Have you checked the stock market recently? Because we are this close to a correction, but what does that mean for the stock market? What does it mean for you, and what does it mean for what could happen the rest of this year and moving into 2024? Let's go ahead and break it down. When we talk about a stock market correction, that means that the market is down 10% or more. When we get down to 20%, we go into a bear market, which I'm pretty sure most of us remember from 2022. But as of today, in the last 3 months, we are down 9%. So we are just 1% away from an official correction, which could mean that the stock market is turning in the wrong direction. Honestly, if it's down 9%, that's already the wrong direction. Now, for the entire year of 2023, up to this point, the market is up 8.5%, which is solid, but it ain't the 12% that we used to, right? It's not the 10% that it was earlier this year. So what is going on here? I did a bit of research and pulled together 3 main reasons as to why this is happening, and it might give us a window into what to expect for the near future, end of 2023 and moving into 2024. The first one is we saw at least 2 major spikes in bond yields. What are bond yields? That is the percent that you're getting paid on the bond. So think of it like the savings account video that we did, and we saw so many savings accounts paying 4 and 5%. Well, when it comes to bonds, they don't just call it percent, they call it yield. Why they do it, I don't know. It's stupid, okay? Wall Street likes to make up a whole bunch of terms that mean the exact same thing as other things. Okay, but bonds have basically started to pay more. And when it comes to investing, which makes perfect sense here, you want to make as much money as you can while taking as little risk as you can. And bonds are known to be less risky. So as bonds start to pay more, people say, look, why risk making a bunch of money or losing money in the stock market? I have to sell some of these assets and move over to bonds so I can make an easy, safe return or a safer return. And that's why people start to turn to bonds. So that is one reason why it is happening. But the other reason is seasonality. Now, we did an entire video on why this is one of the worst periods to invest. And we talked about what the worst month to invest was. And we are in this period. Now, thankfully, or hopefully, history is going to be our guide here. Starting in December, the market starts to take off due to the Santa Claus rally. But really, September, October, November, things start to slow down. The stock market does start to taper off, and that is something that we have seen. And it is something that happens almost every year. Now, that doesn't mean that the stock market drops 10% every time, right? But it does start to slow down, and that's a big part of what could be happening here, and something that you do want to be aware of. But the X factor here is earnings. Now, we have talked a little bit about this, but we didn't get into super deep detail. This is earnings season, and the tech companies are coming out and telling us how well they're doing. Remember, the vast majority of the stock market, the returns are based on how well 7 companies do. Right, and these are the culprits that you know: Microsoft, Amazon, Google, Netflix, Meta, Nvidia, blah, blah, blah. Okay, how they do really pushes the entire stock market one way or another. Meta has already come out and said, hey, look, we need to adjust how we expect to do because ad spending isn't what we expect. Amazon Alphabet, aka Google, has also said, hey, ad spend is not what we expect. We're not making what we expect to make. Let's make some adjustments here. Now, are they making money? Yes, but when they start to reduce their guidance, that starts to create a chain event. It means the stock market could continue to fall. It means we may not feel as excited about tech. It could mean down the line that they could do some layoffs, and that is going to do what? It's going to scare people and make them think that we're going into a recession, which is not impossible. Okay, it's not impossible. I don't think it's as likely because unemployment is still low, people are still hiring, so on and so forth. But it is a reality that we do have to have on the table. Okay, but I don't think that we need to go ahead and pull that lever, but you should be prepared, as we have talked about before, in case anything is to occur. But what should you do as an investor right now? Okay, you know the market is starting to trend down. We've known that for 3 months now. We may or may not hit a Santa Claus rally at the end of the year, but there are conflicting reports around what to expect for Q4. Some analysts and bankers are saying, hey, we're going to be fine. People are going to spend money during the holidays and everything will be okay. You've got others that say it's going to be the worst holiday season that we've seen in the last 3 or 4 years. It's really difficult to call which way it's going to go. Also, don't forget that we've got a lot of new factors that we have not had to deal with in the last 3 or 4 years in people paying student loans and a lot of other bills coming online that weren't always used to paying 2 or 3 years ago. So it could be different. What should you do as an investor? What I would suggest, and what I am also doing myself, is start to look at your portfolio and start to look at what you may want to trim and what you may want to pick up in either scenario, right? So I think you should probably continue to hold tech to a degree, but expect things not to be the same in 2024 as what you saw in 2023. I say that every year. I say that every single year, but that is something that you do want to consider. Also, take a look at what is on sale right now. Is there a tech company that you know you like and that you loved and that is just happened to come down in price? This could be a time for you to pick it up for the long term. Okay, what I do want to caution you against is absolutely selling and just getting out of everything. I do think too, there's another thing, if we want to kind of cut these up into 3 sections, it could make sense to take profits. Okay, which means, let's say I bought a stock for $100, it's up to 200. Maybe I just sell half of it. Like, don't forget, when you sell a stock, you have to sell it all, right? I can sell just a piece of it, keep the rest, and keep things moving. So at least I retain some cash. I get to enjoy a bit of the money that I was able to make and then go invest in other areas. And that's probably, I would say, what I am going to do the most of come this season, because this is the time where I start to reevaluate my portfolio. I really start to make the moves in December by making that list now. What stocks do I want to pick up? What do I want to get rid of? What do I want to trim back and start to make some moves? This is that opportunity that I think that is the best thing for you to consider doing right now. The main thing is don't panic. Okay, and the reason why you don't want to panic, the exact same thing I said back in 2020 when you didn't want to panic then, is we can easily start to see the market taper off. Then in December, things start to take off, and then everything is fine in 2024. That is possible. Okay, the opposite is also possible, but what we know, long term, you selling, you panicking is not going to be something that helps you. All right, now next thing you need to know is what should you add to your watch list and what you might want to take off, and then what is going on with the economy as a whole. If those are your questions, and honestly they should be right now, these are the videos that you should check out next.